Advanced Inventory Management. This chapter represents the core knowledge of working capital and inventory management. It embodies, perhaps let me call it, the state of the art in current concepts on the subject matter and of the related operating best practices. The last couple of decades have been a time of transformational change in the parts business. Advances in logistics and distribution systems have dramatically cut parts shipment lead times. Corresponding advances in inventory management systems now facilitate just-in-time inventory management processes that can lead to dramatic reductions in dealership inventory investment. So in this topic, we will define critical inventory management performance measures and then apply them in optimizing inventory investment and in fine-tuning systems parameters for optimal working capital management. And this objective is captured in the following 5 learning outcomes. And I'll elaborate on each of them briefly by way of introduction. 1 is differentiate and critically evaluate weekly and just-in-time stock order systems. Where the option exists to use either WSO or the JIT Open Daily Order System, what are the pros and cons to choose either option? Second is identify and define the major inventory management performance measures. There we discussed in the context of Chapter 2 5 issues in inventory management. And these 5 issues in this chapter are translated into 5 areas in which key performance measures exist. And what are those measures and how do they apply? 3 is appraise days supply decisions in optimizing inventory investment. And days supply is used for best stocking level, best reorder point, and some other inventory level decisions. 4, employ EOQ, and EOQ stands for Economic Order Quantity concepts to weighing the holding versus acquisition cost balance. All DMSs use some form of EOQ logic in order to make inventory decisions, and how are they applied, and particularly where I can specify certain parameters, what effect will that have? And 5, demonstrate user-specified DMS settings in refining dealership working capital management practices. How to customize, in essence, the DMS to best meet your operational needs. Now, we get next to the just-in-time open daily order system because this is the most prevalent system today. So I'll give you some elaboration on that. We've discussed the WSO system, the weekly stock order system, and its features in Chapter 3, and I'll continue throughout this discussion to compare and contrast the WSO and the just-in-time system. But let me just observe first, before I go in there, because we identified 3 systems, the other being GM's RIM, Retail Inventory Management System. It is similar to the just-in-time system in its capacity to manage inventory turnover, except that it is controlled by the manufacturer's server database to provide automatic stock replenishments. But its outcomes and its sophistication in terms of reducing lead times and managing inventory investments are quite similar to the other JIT systems. So what's the JIT Open Daily Order System? The first 2 bullets deal with submitting orders. It allows submission of any number and types of orders during the day. In fact, in most dealerships, during the order process, they may not even identify, is this a stock purchase, is that a supplementary purchase, is this an emergency purchase, because I can submit 10 orders during the course of the day and just let them accumulate, and all those received prior to a daily cutoff time will be delivered overnight. And meaning delivered overnight, the manufacturer contracts with a carrier with which it arranged access to the dealership to a lockable compound in the dealership, and as orders are picked up at the end of the day, they're delivered to the dealership during the course of the night into the locked compound, and they will be available at the start of the business day next day. Okay. Now, let me use an example to illustrate that. In the central region, I'm based in Ontario, and Toyota, that is an example I use frequently because they're an early pioneer of that system. A central region dealer has until 4:30 in the afternoon to submit the daily orders. At that point, there's the cutoff, and then that whatever's been ordered is bundled and delivered overnight. Now, clearly, the lead times are dramatically reduced in that setting, and it facilitates reduction in inventory investment. And typically in the WSO system, it's common to have 3 months supply, which is 4 inventory turns during the course of the year. And in the just-in-time system, a good guideline has traditionally been 30 to 45 days supply. And perhaps let me qualify that. I previously said that Toyota just released its 2015 dealership operating guidelines, and they now say 0.5 to 1 month's supply in their setting, and that's basically 15 to 30 days supply. So that's a dramatic change from previous common guidelines. Now, it eliminates stock order discount. In fact, most just-in-time systems don't even require you specifying whether this is a stock purchase or a daily or supplementary order, so it's not even identifiable to them whether this is a stock order. I will emphasize, and will continue to do that throughout this course, it is necessary in the dealership to identify, is this a stock purchase or is this a supplementary, a daily order, in order for the DMS reports to be meaningful. But certainly in terms of purchasing under the daily order system, it's just one order type. It retains the obsolescence accrual, and most manufacturers typically have 3% obsolescence allowance, and that is an allowance there to return redundant parts without restocking charges. Now, some manufacturers, a couple of them as of this preparation of this materials, will give the dealer the option to use either the WSO or the JIT framework to submit orders. And which choice promises a better return on investment must therefore be carefully evaluated. And I guess the evaluation first is then a financial evaluation. And this slide provides an example of such an evaluation. And there are a couple of assumptions made to compare that. First, we assume that the dealership has $1.2 million worth of sales per year. And it emphasized particularly here at cost. Why is that at cost? Well, the sales on the financial statement and the inventory investment in the DMS are different price levels. The DMS, we've previously emphasized, is at cost or net realizable value, the lower of cost or net realizable value, and certainly on active parts that would be the cost, whereas the sales are at whatever markup they are in the various accounts. So it is convention, and in fact probably the easiest to do, to reduce the sales on the financial statement to cost of sales, and that is sales minus gross profit, and these two are shown in the columns, equals cost of sales, and then that reduces sales to cost of sales. Now, we are assuming here that in the just-in-time setting, we will accomplish 12 turns per year, and that's a good number. And in the WSO setting, 4 turns a year. So that translates into, if I have $1.2 million worth of sales, an average inventory of $100,000, 12 times 100,000 is 1.2 million, and 4 turns in the WSO, so that means 4 times $300,000 in inventory investment makes the 1.2. So there's a plus $200,000 inventory investment, which clearly ties up additional, significant, dramatic additional working capital. Now, a couple more qualifiers. In the weekly stock order setting, the 5% stock purchase discounts that are common and the 3% obsolescence accrual, which also the just-in-time system has, are only available on stock purchases. Daily and supplementary orders, you forgo the discount and the obsolescence accrual. And I'm assuming for the purpose of this illustration that the dealer using the WSO system has a 70% stock order performance. In other words, 70% of all purchases are stock purchases, and that's a good acceptable guideline. It's usually higher than that today, but let's use that as a minimum. Okay. Now, what is the incremental effect of the respective parameters here on the overall outcome? The stock purchase discount, none at the JIT system, $42,000 for the WSO system, and that's footnoted here with a 1 asterisk. $1,200,000 worth of sales at cost. 70% is my stock order performance, 5% is my purchase discount, 1.2 million. Multiplied by 0.7 by 0.05 is 42,000. So I'm ahead 42,000, a significant advantage, because this $42,000 purchase discount is a direct addition to gross profit. Now, obsolescence accrual is available on total purchases in the just-in-time system. So 0.03 times 1.2 million is 36,000. And in the WSO here, the double asterisk footnote, 1.2 million by 0.7 by the 3% obsolescence accrual is 25,200. And now I'm falling behind by 10,000, or there's a deduction from the benefit by $10,800. And interest on working capital invested in inventory, and I've used 8% as the cost of capital. That's usually, let's say, a line of credit or something like that in dealership that is a good financial risk. 8% is typical. So 8% of the 100,000 investment is $8,000. 8% of the 300,000 investment is $24,000. So it costs me an extra $16,000 of interest or opportunity cost, at least if I'm not dipping into the line of credit, 16,000. So here, in the just-in-time system, I have $36,000 of obsolescence accrual, the benefit, and the cost of working capital tied up of $8,000. So that's $28,000 is the net benefit. In the WSO, we have the $42,000 worth of purchase discount, 25,000, which adds to that of the obsolescence accrual only on stock purchases, but then the significantly higher opportunity cost of working capital tied up, 24,000. So 42,000 plus 25,200 minus 24,000 is 43,200, and that's a difference in favor of the WSO system of 15,200. Clearly, the 5% purchase discount substantially overwhelms all the other benefits where the just-in-time system is better. So clearly the WSO wins. And that may be one of the reasons why more and more manufacturers have shifted to the just-in-time order system, because that's a significant expense or foregone revenue, the 5% stock purchase discount. So it's clearly tighter revenue management from the manufacturer's side. Yet, if the WSO always wins, there may be other factors to consider. Maybe the dealership has a tight working capital position, and the $300,000 is just not money that I'd like to tie up. Or maybe we have a problem with enough support staff, so frequent orders are a problem, and or whatever. There may be part space to handle the $300,000. So there may be other factors. It's never quite as simple as that, but from a purely financial analysis basis, this clearly is the outcome, and the WSO wins. That gets me into the core of inventory management, and that is relevant performance measures. Now, understand this content in broad terms if your focus is that of a general manager monitoring departmental performance. I certainly suggest you understand it in detail if you are the parts manager and you're trying to be a sophisticated, advanced inventory manager. And that will do with the 5 areas as outlined during the discussion of the learning outcomes. And area 1 is level of service. fill rate. It's a measure of availability. And there are a couple of different labels. And the first one that you see up here is the sales closing ratio. The next two slides get into level of service as another measure. And the third slide following this is demand filled from stock ratio. And they are progressively more precise measures and more meaningful measures of level of service. The standard system setting in the Reynolds system uses this measure as the level of service. And that is the sales closing ratio. It's typically called, more properly called, it's not really, in my view, a true level of service, and that is dividing the cost of sales by the cost of sales plus lost sales, and that we previously defined cost of sales plus lost sales as total demand, and it shows net sales at cost. In other words, if the numbers come from the financial statement, then you need to reduce the sales to cost of sales. You can, by the way, get the sales from the DMS, and it depends on entry and relative updating of the financial statement versus DMS updating. It may be not precisely the same, but it may be okay for sort of broader measures, because if you get it from the DMS, then it will be at cost, because the DMS keeps everything at cost. And lost sales, then the third variable here, is demand for parts that was not filled through a regular sale, customer order, or emergency purchase. It was a demand on your inventory where the sale was lost because you couldn't meet customer expectations, or perhaps a customer wouldn't wait to get it in. So it says as a guideline should be approaching 100%. Now, why do I say that? Well, the difference between whatever you calculate and 100% is determined by lost sales, and lost sales clearly should be minimized. That should be a relatively small number. But on the other hand, again, when I say I don't call this the level of service, I call it the sales closing ratio, this is a weak measure because it says little about your stocked inventory's ability to serve customer demand. And I'll get to that in a moment when we look at some of the better measures that come next. Make one additional observation. Where this is 100%, it inevitably means that the parts department is not keeping track of lost sales, because every parts department has some lost sales. So that should be the instant conclusion when you see 100%. Well, clearly they're not tracking lost sales. Now, the sales closing ratio, and I've already started that discussion, is really about the ability to get the sale. In other words, the sales closing ratio probably says more about customers' patience in waiting for special orders to come in than it says about whether you stock the right part or your inventory's ability to meet customer demand. So we need a better measure, and that's that level of service, that ADP, which uses both the sales closing ratio and that demand filled from stock ratio, which it calls demand filled from stock. This is one that's much more precise and is a meaningful number. And this level of service used in as a better guide, and has a guide of 85 to 94%, is a cost of sales minus, in other words, sales expressed at cost, minus the sum of emergency purchases plus special orders divided by cost of sales plus lost sales, which is total demand. It can be calculated using both dollars invested or parts pieces. Both are equally effective because this is more of a financial measure. Okay, so level of service is, when you look at that, if you take, and let's say you're in a weekly stock order system where you have stock purchases, you have emergency purchases, and you have special orders or supplementary orders. Well, if those are the only orders you submit, well, it would be fair to say then I have what's left here after I deduct from cost of sales the emergency purchases and the special orders must be that proportion of cost of sales that was completed from parts purchased under stock orders. So really, if that assumption is fair, then this level of service formula reduces to stock purchases over total demand, and that stands to reason. It's intuitively obvious because stock purchases by definition are purchases to replace demand normally in inventory over total demand, and that's a true measure of service, is my inventory's ability to serve customers. So this is the second measure. And the third measure, same kind of guide, 85 to 94%, is today considered the most valid. It adds lost sales to the numerator, and it is the true demand filled from stock ratio. And obviously lost sales is demand not filled from stock. It must be calculated using parts pieces, not part numbers or dollars. And again, there's probably a bit of an obvious explanation. Let's say I have a service job that needs 4 pieces, a set of 4 pieces to complete the job, and I only have 3 on the shelf. Well, I can't complete the job. Demand is not filled from stock until the additional piece comes in. So pieces is usually the better number rather than dollars. Okay, so what it does is demand filled from stock is use total demand. And remember, total demand expressed at cost, so that's cost of sales plus lost sales is total demand. Both the left variable on the numerator and the single variable on the denominator, total demand, cost of sales plus lost sales, and then minus the sum of lost sales plus emergency purchases plus special orders. And 85 to 94% is a good number. That's today considered the most valid measure. Now we get into area 2, and that's inventory turnover. We've talked in a couple of contexts about the importance of inventory turnover, and the first measure is gross inventory turns. And a good guideline in the WSO setting is 4 plus annually. Okay, it shows in the asterisk on a footnote on the bottom 5 to 8 plus annually in the just-in-time part system. Well, if Toyota used to say, and this is a qualifier, as a general guide, 5 to 8 is still out there, but Toyota used to say 8 to 12 turns annually, and since the 2015 operating guidelines release, it now essentially 12 to 24 turns annually if their recommended inventory level is half to 1 month supply or 15 to 30 days supply. So clearly this is a dramatic change from previously. So gross inventory turns is total cost of sales, everything that moved out over parts and accessories inventory. Now, let me first emphasize this, and this is crucial because it distorts the number totally. It is up and top 4 plus annually. It is measured on an annual basis. It must be done on an annual basis. If you just use 6 months cost of sales, so basically the gross inventory turns would half. So if you look at a 7 months year-to-date statement, let's say the July statement, and I'm calculating sales minus gross profit is cost of sales, I would have to annualize those costs of sales to make this a meaningful number. So divide the calculated cost of sales by 7, multiply it by 12, and that's the total cost of sales annualized over parts and accessories inventory. Where there is a material difference between fiscal year beginning inventory and ending inventory, in other words, the opening inventory on January the 1st and the closing inventory on December the 31st, averaging the inventory denominator provides a more accurate snapshot. And how does that happen? Let's say during the course of a year, a brand new model was introduced by the manufacturer that has a whole host of brand new parts, and typically you get shipped an initial parts order without any kind of qualifying, and it simply arrives, and that would be a significant addition to inventory during the course of the year. So ending inventory would be historically high, and it should be average. Or maybe more internally, I have a new strategy to focus aggressively on the wholesale business, and I need to raise my inventory level in order to serve that at reasonable service levels. So that would be another factor in changing significantly beginning to ending inventory. So if that's the case, average the two, then the denominator becomes a more meaningful number, and it's a more precise measure, a more accurate snapshot, let me say, call it that. Now, Turnover, I've already emphasized, is calculated as a 12 months average for the entire inventory. So make sure that you are looking at either the December statement, or if it's not the December financial statement to calculate cost of sales, then annualize the cost of sales. But a gross inventory turn rate of 4+ times a year usually indicates that parts and accessories inventory is producing enough sales and gross profit to justify investment. And I'll come back to why usually is highlighted here. A rate substantially above 4 could suggest inventory may be underinvested, or maybe above the 24 in Toyota's startlingly high levels may indicate that you're underinvested, that you end up having a lot of special orders and lose some of the discounts that are available, etc. So be careful about not saying, in other words, what it says, a high gross turnover rate does not necessarily reflect good inventory management. So we need a better measure than that, and that really comes in here. There's the but. But gross inventory turns is a misleading measure. Not all parts sold become an actual part of inventory. There may be a special order that moves right through, nor do all parts in inventory sell. In other words, if every piece that you sell during the fiscal year were from a special order, the gross turns would still be the same, yet not a single piece of your inventory has actually turned. And let me maybe give it a more dramatic explanation on that. Let's say, and I'll use very simple numbers to illustrate the point here. Let's say I sell $200,000 worth of parts a year, $200,000 at cost, and I have $50,000 worth in inventory. And let's just assume, forget the reason why, that I cannot get into my parts department for a year, and maybe I had a fire and then I argue with my insurance company, and police comes in and puts a yellow tape across it, and that takes a year to get sorted out. So I have $200,000 worth of sales and $50,000 of inventory behind the yellow tape. But since I can't get in there, I use my parts driver to run out all over the city to other dealers and maybe the traditional aftermarket to find me the parts to continue to stay in business for the year, and I produce again the $200,000 worth of inventory. So my gross turns would still be 4. 200,000 divided by 50,000. Yet not a single part from my inventory is actually turned. I couldn't even get into the parts department. So clearly we need a better measure of actual inventory investment. And the better measure that is used is this measure, inventory true turns. The measure in the weekly stock orders is 3 to 5 turns annually. And in the weekly stock order setting, in the just-in-time setting, typically 8 to 12 turns. Toyota says a minimum of 12 turns today. So it is a more precise measure. Why? It uses in the numerator stock purchases, not the total cost of sales. That proportion of purchases that were to replace parts to replenish sales from inventory. So this is actually my inventory that's moving, and that's clearly a measure of inventory effectiveness, whereas the first one, the gross turn measure, is really just about working capital management. The gross turns measure is widely used. It will be used by the bank to determine liquidity, and because it feeds in directly to working capital management, and also by the manufacturer. Page 1, the balance sheet of the manufacturer statement usually has a working capital number that is, there's a minimum working capital criteria, so it's widely observed, but it really says nothing about how effective my inventory is or whether I stock the right parts. That's only inventory true turns can do that. And as already illustrated, guidelines vary by manufacturer, so I encourage you whenever you do your evaluations to use the relevant guidelines from your setting and probably from your own manufacturer, perhaps through peer consulting groups. Now a final measure in area 2 is purchase efficiency. We used to call this stock order performance because the more common instead of calling it purchase efficiency percent, we used to call it stock purchases percent or stock order performance, and it had in the numerator stock purchases over total purchases. Since the JIT systems usually only have one order type, the term purchase efficiency is more meaningful. And what are efficient purchases? Well, they're those purchases that afford the parts department the highest eventual profitability when the parts are sold. And clearly in a weekly stock order setting, that would be stock purchases, which give me the purchase discounts and the obsolescence accrual and the just-in-time setting. Any purchase will give me obsolescence accrual and maybe free freight, or however the source, as we've entered it into our DMS, may identify them as such. Efficient purchases afford you the highest eventual profitability because you're taking advantage of all the benefits that are out there. Okay, now we get into the next area 3, and that is inventory investment. And that really falls into the area of inventory movement. Many studies have been done over the years assessing dealers' typical inventory movement, and they usually identify the following common practices, and this was usually done from major databases of groups of dealers or in DMS systems by performance group. That 3 categories of patterns. The first, 65% of parts that go 6 months without a sale will not sell in the following 6 months. In other words, it's already more than likely, or more likely than not, that it will be an obsolete part by the time we get to the end, or an absolutely obsolete part by the time we get to the end of the fiscal year. This is usually given the label of technically obsolete, and in fact that DMS setting for 6 months without sale is that it goes into automatic phase out. Second, a part that goes 9 months without a sale has an 85% probability that there will be no sales demand within the next 3 months. 9 months, no sale. Okay, that's given the label of obsolete. In effect, even if I have 1 sale in the remaining 3 months, it still would not qualify for stocking. So it's obsolete. It should be staged for orderly return to the manufacturer, because the longer you wait with these kind of parts that don't move, the higher the probability that they actually become non-returnable parts because they don't move for the manufacturer either anymore. And if that's the case, then I guess you'd have to scrap them if you want to get them out of the inventory because they're no longer returnable. And a part on the shelf for 12 months, when sold in the subsequent 12 months period, will not produce a profit upon the sale of that part. And in fact, this is our definition of obsolescence, a part that I can't make any money from. So if I can't make any money from the part, I shouldn't have it. Now, common criteria, and this still comes from the WSO world, common criteria for 6 months no sale is less than 35% of the total inventory investment. It is on phase out typically if it hasn't sold in 6 months, but it's interesting in some of the later numbers. Toyota now says less than 10% of parts with 6 months no sales should be in inventory. So clearly there's an urgent need to continue to return parts that seem to accumulate months on the shelf. And 12 months no sale, a typical guideline is less than 10% of the total. Toyota used to say less than 5%, and that is reflected here. The just released operating guideline now says less than 2%. Okay, now when we talk about absolutely obsolete down here, why can't I make any money? Well, we've said that anything that sits on the shelf for 12 months has accumulated an holding cost equal to 30% of the value of the part. And if my typical parts department total profitability, and that's a good financial guideline, is 28 to 35%, well, 30% holding cost, let's say an average of 30% total profitability, I best break even. It should not be on the shelf. It's a redundant part. And that gets me into the 4th category, excess stock and obsolescence. Excess stock, it says here, less than 25% of total inventory dollars or of total inventory investment. And excess stock is defined as any stock where the on-hand and on-order quantity exceeds the best stocking level. And usually this is conscious or intentional in most cases when you look at excess stock. Maybe the manufacturer had a special seasonal promotional campaign where we get an extra 10-15% discount on fast moving high volume parts. Well, it makes sense to say that the extra 50% discount by far outweighs the potential holding cost of an additional inventory. So let's say instead of 45-day supply, I say I bring 120 days supply in. Well, I've created significant excess stock. Other areas where excess stock is intentional, maybe I've experienced a period of fairly high fluctuation in inventory management, high variability, and I'm saying, well, in order to make sure that I don't run out, I increase my safety stock, the days of supply I keep as safety or buffer stock. And the third area where it happens automatically, let's say I need 5 pieces and my stock order calculates that as I need 5 pieces of that particular part, but it only comes in packages of 12, so I have 7 pieces of excess stock. So it's usually conscious and in large measure intentional, this kind of excess stock. Now the next two categories are non-stock parts in part numbers and non-stock parts in dollars. Now, what are non-stock parts? Non-stock parts are parts on the system coded with a special status code of NS. That's what all major systems use. And they are on the system to track demand. In other words, they're not included in inventory calculations, etc. They're simply sitting on the non-stock parts file, and if someone calls in for that part, clearly I don't have it in stock if it's a non-stock part, and that identifies then I've had one hit on that part, and maybe somebody else calls in 3 months, and now I've had 2. And this is how you track the potential demand for parts that are not normally on inventory to reach a point where you say, well, this had enough demand now, maybe this is warranted for phase-in to make it an active part. Okay, now I have 2 measures here, in part numbers and in dollars. In part numbers, it says here 30% or greater of all parts tracked in the inventory system or entered in the inventory system should be non-stock parts. Why is that? Well, it's an indication of what kind of job you are doing to actually track potential demand. Even if it's 50% or 60%, and maybe many of these don't ever get a hit, the system doesn't care whether you have 3,000 or 6,000 parts in the tracking file, in the inventory file, so it is indicative of a good job being done to track demand, because the non-stock part system is exactly that. It tells me what my potential demand is on inventory. It helps me my supply and demand balance, and when I should be phasing in parts. So the higher the better, 30% or greater on the number of part numbers that are coded as non-stock. Now, non-stock parts dollars. Well, if I have dollars, that means I have investment in non-stock parts. Now, why the heck would I have non-stock parts in stock? Well, it typically means these are special orders, and there may be 2 types of special orders, customer special orders, and in most cases dealerships today expect prepayment or at least a significant down payment to bring in special orders, so it's usually not a problem, these orders moving through the system. But it's more commonly if there is a lot of special order stuff that sits on the special order shelf. It's most typically service department special orders. A customer was in for a given service job and some additional repair was identified, but we didn't have the part in stock, so we special ordered it, and now we have troubles getting the customer in to have it installed. A typical guideline is less than 5%, because these are basically special order parts that are gathering dust on the shelf. It's not something I should have in inventory, so it's just sitting there. And we'll get to that in a moment on what should we do, at what point should we perhaps say these things should be returned, because after 2-3 months it clearly is now probably over, that the customer will not come in unless the service department has some reason to say yes, it will still be used. Okay, so less than 5%. Now, as previously reinforced, and that's that graphic on the bottom, availability versus investment, I've said that no parts department can have a 100% level of service, because the investment needed as you approach 100% increases exponentially. And as indicated here, this is an illustration. This is not a sophisticated research project. I'm just trying to make a point. Let's say I was at 80% level of service and I had $150,000 worth of inventory investment, and for some reason I have now a campaign that I want to reach 95% level of service. Well, it'll triple, according to this graphic, my inventory investment to $450,000. And that's that illustration that it increases exponentially. If I wanted to go to 100%, well, I'd need every piece in inventory at the National Parts Distribution Center that the manufacturer has. Clearly, it is not possible to have 100% supply. Now, that's inventory 4, excess stock and obsolescence. Now I'll discuss inventory area 5, returns and obsolescence, just in terms of major objectives. And the first heading is increase stock orders. And maybe in the just-in-time setting, we should relabel that increase efficient purchases. But certainly in the WSO settings where you have stock orders, many of the studies that have been done have come to the conclusion that each 2% improvement in stock order performance will generate a 1% or better increase in gross profit dollars. This is, as asterisked here, as footnoted here, in a weekly stock order setting. In a just-in-time setting, well, we still have efficient purchases that earn me return allowances and maybe some discounts that are offered according to basic purchase patterns. So increase stock orders, or increase the orders that allow me to track that my inventory is actually moving. Second item is remove dead stock. A 6 months no sale item should be put on automatic phase out, and in fact for most of the major league DMSs, this is the default setting. At 6 months no sale, the part goes on automatic phase out. It sits in that automatic phase out account until we get to the point where the parts on hand become 0, and then it goes to the delete status. And I'll come back to that discussion as we are progressing with some additional measures, but certainly automatic phase out is the file that I should look at, because the probability that it will not sell in the following 6 months, as we've just seen, is already 65%. Clearly it will not meet minimum stocking criteria that we are defining. For seasonal parts is somewhat different. The phase out is typically considered any 2 seasons, and that means for example winter tires. Winter tire seasons, maybe my stock comes in September, the main selling season is October, November, then it starts fading out, and the 6 month phase out point would be February, March. Well, clearly nobody sells winter tires anymore, maybe certainly just some exceptional sales, but then should I return it or phase it out? Well, not, depending on returnability. If the manufacturer has attractive return programs for special purchases for tires, well, maybe, but certainly for seasonal parts, phase out is any 2 seasons, which could be anywhere between 12 to 15 months. Phase out next year in November, when basically the snow tire selling season starts fading out. Improve inventory control accuracy, the third item. In other words, that means rigorously track all critical key performance indicators and make your decisions based on facts, on analysis, not on gut feel. That's improve inventory control accuracy. And the final one, install rigid purchasing controls, meaning minimum qualifying rates as sales turnover rates before I put something in inventory, and we'll talk about that in a moment. And particularly resist speculative buying, as I call it. And speculative buying is saying, well, a new model has been introduced, a whole bunch of new parts, and this typically has sold with previous models, so let me bring some pieces in inventory to see what happens. That is a recipe for excess stock and for obsolescence. Bring something actively in the inventory only when it has met rigid purchasing guidelines. Okay, this covers the 5 areas in inventory management, and as I said, they parallel the 5 issues in inventory management we talked about in chapter 2. Now, we get into another area, and that's best stocking levels and best reorder point, another learning outcome. And that essentially deals with how often must a given part be ordered and in what quantities to control emergency purchases and special orders at a level that meets the dealership's level of service objective while optimizing purchasing cost. And this answer involves decision variables applied in calculating BRP, best reorder point, BSL, best stocking level, and EOQ, economic order quantity. So let me begin explaining this with the following graphic, and it has the heading of working versus safety and buffer stock, and you can see the red line here, that's my working stock, the safety stock, and there's different labels used, safety or buffer stock, and say a minimum of 6 pieces, and this is, as we can see here, this is a part that has a demand of 2 pieces per day. Because here, day 1, we start with 20 pieces, day 1, we're down to 18, 16, 14, 12, etc. So the demand is 2 pieces, so my safety stock is 3 days of supply, and that happens to also equal the lead time my order lead time, where from day 4 to 7, I place my orders, and day 4, they expect to arrive in day 7. Okay? Now, this is quite simple, and it means with absolute certainty, or it assumes with absolute certainty, this is exactly what happens. So we start here with a 20-piece best stocking level for that part. And day 1, it's down to 18, day 2, it's down to 16, day 3, it's down to 14, day 4, it's down to 12, and that's my best reorder point as it is set here. Now, how many do I order? Well, look at this. My order is placed, but it takes 3 days to come in. So I order, here I have 12, at day 5 I'm down to 10, at day 6 I'm down to 8, and at day 7 I'm down to 6. So my reorder point then means I need to order 14 pieces, because by the time the order comes in I'm down to 6, and now the 14 plus the 6 brings me back up to the best stocking level of 20, and the cycle begins again. So this is a simple illustration of what we are trying to accomplish. It means absolute predictability and nothing random to anything, and that's why additional days are added to safety stock, and additional days are added to reorder point and best stocking level, etc., because there is clear, tremendous randomness to that. Then let's first look at how BRP, best reorder point, is determined, and that gets into specific discussions of lead times and components of lead times here. And this here assumes the dealer uses a weekly stock order. It takes 1 day once the stock order is produced to review it. The parts manager reviews it. Is that all I want to really order? Some I want to take out because I have some other consideration on that. So it takes 1 day for the order to be reviewed and placed. And then weekly stock order lead time, and that used to be fairly common, maybe different by different manufacturers, was that the lead time was a guarantee of we'll ship it within 48 hours of receipt of the order, not counting the day the order was submitted, plus, let's say, depending on how far away from the parts distribution center I am, it's 2 days for shipment and receipt. So my lead time then correspondingly is the day of the order submission, the 48 hours of delay before it gets shipped, and the 2 days shipment receipt. So 5 days. And my safety stock, I'm using the previous 6 pieces, 3 days at 2 pieces each. So what is the best reorder point? Now, my order frequency is weekly stock order, so it's 7 days. My order review time is 1 day. My lead time, shipping lead time, as defined on the left, is 5 days, and my safety stock is 3 days. So my best reorder point minimum would be 16 days. Well, again, it assumes absolute constancy or predictability and no randomness to these patterns. Unfortunately, the world is rarely this predictable, and random variations must be factored in. And I'll come back to that in 2 slides, because that's then where you see a potential range for each of these variables to say, in order to cover myself and cover that randomness, I need at least that much. So now let's look at how is best stocking level and best reorder point calculated. And it's usually expressed in day supply, as you see here, and I'll start with best stocking level. The quantity required would be the annual unit sales for that component multiplied by the number of days supplied divided by 360. Why 360? Because there's 365 days in a year. Well, that's convention to use it, because this would be just a fraction, point something of a day, and that really doesn't make much difference. So that's a nice round number. Now, let me explain this by use of an example here. And here's an example. Suppose sales of a specific oil filter unit totaled 64 pieces during the last 12 months. The parts manager decides to maintain a minimum of 45 days supply in inventory. How many pieces is this? Well, I guess the calculation, according to the formula above, is 64 pieces is my annual demand, 45 days supply is my quantity I want to keep in inventory, divided by the 360, and that equals 8 pieces. Now, this is the best stocking level. And let me then come to the best reorder point that we talked about a moment ago, and how do we deal with random variations in demand which affect both best stocking level and BRP. This example illustrates a potential range, and again it's just an illustration of variation and how the BRP is formally calculated and how it is affected by those variations, and it's always expressed in the number of days supply required to cover expected order lead time. So here we have days in order cycle, and again simply an illustration, may or may not be the case in your dealership. Input demand, it's typically we do it in 1 day, but it may be up to 2 days. Calculate my stock orders, well, and submit the stock order. Could be on average 3 days, but it could be as high as 7 days, because if I've just submitted an order 5 minutes ago and another order comes in, I have to wait for a week now if I want to place that demand by a stock order. Enter the order, usually 1 day, but it could be up to 3 days. Now, shipment lead time, particularly if there are back orders or whatever other constraints sometimes exist, at 5 days, let's say, is normal in my area where I'm a given distance away from the parts distribution center, but 3 to 10 days are possible. Put the part in stock. Maybe we do it the same day when it comes in, but if we have bundles and bundles of part shipments coming in, well, maybe it takes a couple of days before we actually get it on the shelf, and then it's still not available for sale. When we looked at our parts order cycle, it's only available for sale once it's been put on the shelf and inputted in the system as now in the inventory. Then when the parts counter person brings up a screen for that part, it shows as available. So that could be 1 to 5 days. So it could be as low as 11 days or maybe even less than that, but 7 to 30 days is normal. And by the way, 30 days for most settings in the minimum or low day supply, which identifies the best reorder point, I'm told, is in most cases the preferred number. So the reorder point is calculated as follows. Annual unit sales by the number of days in the order cycle, and if it's 30 days as here, that would be the numerator, divided by 360. Now, we've looked at BRP and BSL. Now let's look at a best stocking level example for a fairly low cost part. Let's say it's that oil filter that we calculated a moment ago. It costs $4 each. That's my dealer net price. I have 64 pieces per year of demand. And my reorder point I've calculated as 45 days supply, or 8 pieces. And my average inventory during the course of the year would be 6 pieces, and please take my word for that, and also for the number of orders that this would require. I've done a simulation, and that's how it came out. On average, I would have 6 pieces in inventory, and because these are constant orders, because the day supply are fairly low, I would submit 26 orders during the course of the year. And I have assumed my holding cost is 30% of inventory value, and that's usually considered standard today. And I'm assuming also today most orders are placed online or at a portal, so there's minimal cost. I'm not printing invoices and faxing them or whatever, but it still needs manpower and some effort, and the more orders, the more that adds to requirements for support staff to do that. And so I've given it a marginal number here of $1 each it costs me for the order. So my acquisition cost then is 26 orders entered at $1 each, which is $26, and my holding cost is the 6 pieces that on average I have in inventory by the $4 a unit cost each by the 30%. So 6 times 4 is $24, by 30% is $7.20, for a total cost of holding this piece in inventory for $33.20. In other words, my working capital tied up plus the acquisition, so the combination of acquisition and holding cost. That's a fairly low cost part. And let's say it's a very inexpensive part, and would therefore be instructive to maybe look at what would happen to the total cost if we doubled the stocking level on an inexpensive part like that, because holding cost is clearly the cost of inventory tied up. Acquisition cost is that $1 each per order. So let's go through that calculation if I would double my best stocking level because it's such an inexpensive part. Everything is the same except the highlighted lines here. My cost is still $4 each. My 64 pieces is my annual demand. My reorder point is 45 days supply. My stocking level is 90 days supply, or 16 pieces, because I've doubled that now. And again, take my word for it, what will happen is I'll have on average 10.5 pieces approximately in inventory, and the number of orders that need to be placed has now dropped from 26 to 7. And again, at $1 each, and average holding cost stays the same, 30% of inventory value. So now this calculation is 7 orders entered at $1 each is $7. 10.5 pieces by $4 per piece each, multiplied by the 30% holding cost is $12.60. I'm now at $19.60 total cost for that part over the year, combined holding cost and acquisition cost. Now, $19.60, we were previously here $13.20, and we've reduced that now to $19.60. In other words, the savings in acquisition costs from 26 orders annually to 7 annually by far outweighed the proportionally smaller increase in the holding cost for an overall cost reduction. And we'll see that illustrated later when we look at EOQ quantities by price range. So what does that mean? What have we illustrated here? And this is where we get to economic order quantity, and that is an illustration of it graphically. What we've seen in action is really the concept of EOQ illustrated here. And here's my dollar part. Let's say my $4 part, 1 unit is $4, 2 is $8, 3 is $12, etc. So my holding cost line increases in linear fashion by the unit cost multiplied by the quantity on hand. My acquisition cost, you can see here's a curvilinear relationship, and it first declines steeply and then gradually starts leveling off, and I guess to use mathematical terms at infinity it would be horizontal. Now I've illustrated holding cost. It's the number of pieces in inventory multiplied by the unit cost. Why is this curvy linear originally descending rapidly and then leveling off? Well, the best thing that I can use to illustrate, one manufacturer that I used to work with in the past for a period of time had a $30 supplementary charge to any part ordered as an expedited emergency order where special couriers were used, etc., because that created additional cost. So that $30 additional charge, and that is here, remember, acquisition cost that we're looking at. $30 additional charge was a direct addition to cost if I ordered one piece. If I ordered two pieces, well, that now was defrayed over two pieces, so it added to each piece $15 each. If I ordered three pieces, it was $10 each. If I ordered four pieces, now it was $7.50 each. If I ordered five pieces, it was $6 each. If I ordered six pieces, it was $5 each. Realize how it diminishes by lower and lower rate. And that is that initial steep decline and then starts leveling off. And mathematically, and this is a question of calculus, if you're that inclined to calculate it, where the acquisition cost line and the holding cost line cross, that is the minimum point, and that is minimization calculation in calculus. So the total cost line decreases for a period of time, less and less and less, and then at this point the holding cost overwhelms the acquisition cost saving and total cost rise. So that's economic order quantity. Now, I've a moment ago said the oil filter example was a small cost item. What would happen if we double the days in inventory? Well, let's use that in terms of a more expensive part. If the slope of the holding cost line here, it's certainly relatively flat. What would happen if the slope were steeper, as is the case in a more expensive part? Let's say it's a $40 part. At one unit, we already be at 4. At two, we would be at $40. We'd be at $80, so it would go straight up. Well, let's look at that, and I'll go to the next slide for that. You see the stocking levels and reorder point coming up. I'll come back to that. Let's just have it stand there for the moment. I look at two scenarios. A stock level 1, that's the 45-day supply that we had previously done with the oil filter example, and the next stocking level is the 90-day supply as we had done when we compared the one against the other. Now, the difference here is only the cost. It's still 64 pieces a year in total demand. 45-day supply is my best reorder point, and here I'm using a best stocking level of 45-day supply. Here I've doubled it to 90 days. That's my 16 pieces, and as previously said, take my word for this, 6 pieces on average in inventory, 10.5 pieces on average in inventory. In this scenario, the $1 order cost, the 30% inventory holding cost. So the calculation would now be as follows. Acquisition cost, the 26 orders by $1 is $26. The 6 pieces on average in inventory multiplied by 36.40 multiplied by the 30% holding cost is 65.52 for a total cost of 91.52. Okay. On this side here, 7 orders at $1 each, my $7. 10.5 pieces in inventory by 36.40 by 30% is 114.66. My total cost is 121.66, and that is an increase in my total cost of $30.14. Now, the proportionately larger holding cost increase in this case then overwhelms the acquisition cost saving for an overall increase in total cost of $30.14. And that is classic economic order quantity in action. So it depends on the cost of the part, how holding cost versus acquisition cost is being balanced. And now let me come back to what I originally left to later. The stocking level, high stocking level, That is, and it's also called max in some settings, or BSL in some settings, best stocking level, is usually a range of 45 to 60 days supply. That gives good results. I would say today probably at the bottom end of that range with our fast turnarounds. And here the low level, sometimes called minimum or BRP in some systems, is my best reorder point. 30 to 45 days usually gives good results. And again, in today's setting, probably closer to 30 or perhaps even something a bit below that. Now, I've been told by many veteran parts managers that if you are, let's say, at the higher end of this range and you've decided, really, I'm wasting working capital here, I'm unnecessarily tying up working capital, and I want to come down from 60 to 45 days for the BSL and from 45 to 30 for BRP, don't do it in one shot, because there are so many different performance indicators and report results tied into this specification that the system goes crazy, and essentially for a couple of months the reports become questionable because they're totally distorted. So the best practice is reduce it a couple of days at a time, let the system settle down, and then next month get another couple of days. So over a period of 1 to 2 years, I probably have reached that low level, and now I'm optimizing my inventory investment. Now, we talked about economic order quantity in action here. Now let me illustrate this by unit cost EOQ, as I call it here. You will probably remember this table from the matrix pricing formula that we used in the previous chapter. The unit cost dollar range from 0 to 50, 51 to $2, 201 to 5, 501 to 20, and 20 and up. Except this time, rather than using it for price escalators, we use it for escalating the day supply. And the reason this is done is typically a significant number of system active parts are low unit cost items. They are penny items, and it doesn't matter if I even have a 50-cent item in the first category, whether I have 100 in stock, that's $50 addition to inventory investment, or whether I have 200 in stock, double my stocking level in terms of day supply, because that's just a $50 change to inventory. That might be a couple of $100,000. So it's really that can be adjusted upward with only a minor effect on inventory investment. And unit cost EOQ, as we are calling it here, is usually applied on a cost break or cost range basis. And here is how it will work. We have the 0 to 50 category. My normal stocking level in it, that is 45 days, and I now to decide I want to double that to 90 days, so it's a change of plus 45 days supply in the stocking level. The next cost range, 45, all of them have 45 days supply, and my best reorder point, as indicated here, is 30 days supply. So my next range is 45 days, and I add 22 days supply to that because it's already a little more expensive, so somewhat less. So now come up to 67 days supply for the best stocking level. The third category, 201 to 5, I'm only adding 8 days because now it's starting to get expensive, the holding cost on that. So it's 53 days supply now with a cost break, and then 501 to 20 I'm not changing at all because these are significant cost parts. But the 20 and up, or 2001 and up, I'm actually reducing by 10 days supply from 45 to 35. And in effect, what I'm saying is these are fairly expensive parts, and they're not that overwhelming in number of parts entered into the system, and I monitor those very, very closely, and therefore I can work with a much tighter day supply because I constantly look at those as orders are processed. Am I still okay with these relatively tight quantity parts? Okay, and that's the common way of applying economic order quantity. So now what happens to actual inventory investment? And I have assumed here, and then calculated accordingly, that my respective, my total inventory was 156,096, and these were the respective dollar value in each of these cost ranges: 1873 for up to 50 cents, 10,145 up to $2 from 51 cents, and etc. 2847 for a total of 156,098. With the cost break, in other words, the doubling of that supply level, it actually doubled went up by 50%, or by $1,873 to $37.46. The next one we only increased by 22 days, and that meant it increased from 10,145, the inventory investment, to 15,105. That's plus almost $5,000 for 48.9%. The third category, up to $5 from 201, increased by $5,000 from 28,407 to 33,407, by just over 5, or 17.8%. The 501 to 20,000 we didn't change, and at 2001 and up we reduced by 10-day supply, and that was a reduction from 56,971 to 44,311, or minus 12,660, or minus 22%. The effect on the total inventory became 156,096 to a marginal reduction to 155,319, a reduction of $770, or 0.5%. The reason that happened is because the stocking level of the over $20 category was decreased by 10 days to compensate for the other increases. So in the highest range, and that's typical to apply it that way. Now, inventory stayed almost the same, but what does it do to our purchasing, my ordering practices? And this are observations from field tests. There have been a number done over the years, and the 4 core observations from that is: stock order purchases increased, because many of these Mickey Mouse penny items are not ordered that frequently anymore, so we're usually ordering significant parts which can usually wait for the stock order. The number of order lines per stock order decreased, again because it filters out many of these small items that simply don't get ordered very frequently anymore, because we have 90-day supply in inventory. The quantity and dollar value per stock order line increased, and that, again, it's more summary orders, and both the frequency and dollar amount of emergency purchases were reduced substantially. So in effect, what it's saying, the unit cost EOQ application resulted in more pieces being ordered less frequently. That's a significant benefit to order frequency and the kind of overhead that needs to be there to support that. There's a final note here. EOQ assumes constant demand, and many of our earlier calculations assumed predictability, and any experienced parts manager knows that that's rarely the case. When demand is erratic, systems use so-called demand filters, and there are usually 2 levels of demand filters. They either automatically adjust orders when unusual demand is spotted. It's sort of a buffer kind of system that's inputted. And the second is that it generates, when there is really radically different demand, that it generates a report for the parts manager to review. I prefer the second method, where you can specify one or the other demand filter feedback devices, because nothing substitutes for the experience of a veteran parts manager who knows, well, this is just a random thing, or this seems to be a significant change in that pattern, so something needs to be changed. So that's economic order quantity and how it affects BSL and BRP. Now, I'll continue with this discussion of economic order quantity applied, and there's really 3 tables, so let me put all 3 of them up because I'm trying to illustrate something. These examples are clearly not rocket science, but emphasize some often overlooked constraints. Let's say it's obvious: if I have stocking level of 1, nothing on hand, I need to order 1. If I have 1 stocking level and I have 1 in inventory, I need nothing. 16 stocking level and my actual on hand is 5, so I need to order 11. 11. That's obvious, but let's apply this third line under special circumstances, and these are some of the constraints that are often overlooked. This one here deals with multi-pack quantities. My stocking level is 16, my actual on hand is 5, order quantity is 11, yet I can only buy these parts in package quantities of 6, so my revised order quantity is 12, and I have instantly one piece of excess stock. And on the right hand side I have on order quantities, and if they are overlooked, they create a real significant mess. Let's see here, my stocking level is 16, my on hand quantity is 5. So I really would need the 11 that are over here, but I have a quantity of 9 on order, and they've been for a couple of days on back order, so I forgot about that, and I still order my 11, and then all of a sudden the back order come in, and I have significant amount of excess stock on hand. So in this case, I have my quantity on hand and my quantity on order combined is 14 pieces, and my revised order quantity then only becomes 2 pieces. Again, not rocket science, but don't overlook some of those constraints. Now, let me go to the final item in the learning outcomes, the user-specified parameters. And shown here is a typical, the heading calls it source specification worksheet for use with defining user-specified parameters. This is the Reynolds and Reynolds format, and is in fact similar to what we used to use in our DMS course at the business school when we were still using Reynolds and Reynolds. So these are core input parameters, and source specification is the first input parameter, and that can be picked by the parts manager. It may be by movement, whether it's a high volume parts, low movement parts, medium movement parts, or whatever. That's a source specification for a group of parts that are subject to the same parameters, or it may be, let's say, highly visible, highly competitive parts that are typically on menu priced service specials that I want to mark up at different levels because they're really subject to tight margins in order to continue to get that business. That's the source specifications. However, I want to enter that. There's order frequency, there's order review, and I'll come back to that in a moment because I want to discuss something else before I come back to the top part. And there's lead times, and then we get into best reorder point and the safety stock and the best stocking level. All of these can be inputted in that. But I want to illustrate, because we use that in chapter 3, the price breaks and escalators, and we just illustrated the economic ordering parameters. These are the input places in the system. For the economic order quantity, the cost break example that we used, we have here a low cost, high cost, plus the extra day, and that's maybe 0 to 50, 51 to $2, $2 to $5, etc. And I can add lines to whatever extent I want to do. That's the input place for that. And what we used in chapter 3 on pricing formulas, you say my list price is usually entered. The base would be the list price, the MSRP. My trade price may be the parts file base, might be the list price minus 15% or 20%. My warranty price might be the cost price plus the 30% markup that the warranty system allows me to claim, and so warranty is cost plus 30%, etc. So this is typically where it's entered in the system. Now, this is the full list of parameters. I'll come back to it after I want to discuss a couple of fundamental checkpoints, and then I'll show you the top part that is phase in and phase out. So let's look at this here. Guidelines, conditions, checkpoints. Chapter 5 and 6 will demonstrate rigorous performance analysis using DMS vendors and industry standard reports and checklists. And they use these guidelines, conditions, checkpoints that we are about to talk about on a limited basis. At this point, I want to wrap up the topic with looking at additions and deletions to inventory. And first, the additions. And this is classic parameters that may or may not be used at your given dealership. You may want to work with much more rigid controls. But first item here is, until there is an initial demand for a part number, nothing should take place within the inventory and no stock should be ordered. The part should, however, be added to the system as a non-stock controlled item. I've had a demand, so it's a lost sale that goes on the non-stock part, or maybe I didn't have demand. I had this new model introduction where there are all kinds of new parts, and I'm wondering whether a couple of parts that traditionally were moving parts, whether I should stock them. Well, enter them as non-stock parts here until there is an additional demand, and as per the second item here, until it has met my qualifying guidelines, nothing happens other than to add them to the system as a non-stock part. So that gets to the second item. Any part that receives demands in 3 separate months within a 12-month period is considered a profitable inventory addition. And that means 3 separate demands. Not somebody comes in a couple of months and buys 3 pieces. It means 3 separate demands over a period of 12 months. That is a minimum in my view. They're not cast in cement, these kind of standards. Many dealers operate effectively and profitably with much tighter criteria. But that's minimum, and this is time-honored kind of criteria. Only a part that can demonstrate its viability by turning over 3 times a year should be stocked. That's additions to inventory. Now let me go to deletions from inventory. And most of these things we've earlier talked about in the context of control. So let's here look at deletions from inventory. After 6 months with no demand, the item should be put on automatic or dealer phase-out status. This means that any further reordering is suspended, and that, in fact, as I mentioned previously, is the typical system default setting. What happens is that it suspends ordering, it puts that part number into a separate category that continues to be printed out every month as phase-out parts, automatic phase-out parts, and reordering is suspended, and it'll stay in that category of phase-out parts until the quantity becomes 0. And that's improbable because it's a part that hasn't moved. 65% of those parts will not move in the next 6 months. But anyway, if I have 1 or 2 in stock and I happen to have a hit on that and it goes to 0, at the end of that month, it will kick into the delete status. And if you don't do anything about parts that are delete status, that will be dropped from the system, and you may not want that to happen. And I'll come back to that when I talk about item 3. And also it could go to 0 if I usually recommend in a clean inventory use the automatic phase out file to look at which parts should be staged for an orderly return to the manufacturer. So if you return those parts, then the quantity would be 0, and then it would go to the delete status at the end of the following month. So this is technically obsolete, as we've previously identified it. At 9 months no sale, the part is deemed obsolete. Particularly in parts departments operating with limited space, the parts manager should plan for its orderly removal from inventory. And as earlier indicated from the research in dealerships, 85% is the probability that a part that's not moved in 9 months will not move in the next 3 months that are remaining. So it's clearly obsolete, it's redundant, it shouldn't be on the shelf, because even if it moves once, it's still not a qualifying stocking level according to our additions to inventory discussed a moment ago. At 12 months no sale, the part is deemed absolutely obsolete and should be both removed from inventory and from the file of controlled part numbers. It is absolutely obsolete, but you still may not want to drop it from the inventory file. Well, perhaps this is a part that's used also on another model, and then on that other model it hasn't come into its normal replacement cycle, but it is something I want to continue to track. So instead of dropping it from the file of controlled part numbers, The same going for 6 months no sale that have kicked into the delete status. I may say, well, no, I want to continue to track these parts. Let me simply move the 6 months no sale from delete status to a non-stock status again, and the 12 months, even if I've taken them out of inventory, move them into non-stock parts also. The physical stock, however, should be purged from inventory, and perhaps, as we've discussed previously, listed on one of the online parts exchange websites, and I have a separate storage area for the parts that fall into that category. Okay, so these are deletions from inventory. We now return to DMS typical input parameters and Reynolds and Reynolds source specification worksheet. And we talk about typical input parameters, and look at the top. We've already talked about source and the parts description, and the source may be other manufacturers if it's used vehicle reconditioning or by movement or however we want to specify that. Low day supply and high day supply. Low day supply also often called minimum, high day supply maximum. Day supply might be called BRP, best reorder point, high day supply, BSL, best stocking level, but they're all the same. That's the parameters of low day supply. Phase in parameters and phase out parameters come next. So these are what we are seeing, what these settings alter, BSL and BRP. Now phase in parameter, you see here, has demand in X number of months out of the last X months for a total demand of X pieces. So in our additions to inventory qualifier, we've said had demand in 3 out of the last 12 months for a total number of, that could be just one piece or maybe multiple pieces if we want to change the parameters. And other phase out parameters is has been in inventory for X months with an average demand of X pieces, and say 6 months with an average demand of 1 piece. Well, that would be automatic phase out, and you can set that to the number of pieces. Anything less than 3, otherwise it would presumably be considered a potential active part. Now the phase out parameters is have no demand for X months. Automatic phase out would be 6 months, but I may lower that to 4 months if that's what I choose. Have been in inventory for X months with an average demand of X pieces per month, and that may be fairly expensive parts that I simply don't want in inventory if I had it for 6 months, but I had 1 piece over the last 6 months. These are settings that are best specified in the context of your operation. If not phased in, non-stock parts will be phased out after X months. And this gets back to what I earlier talked about, non-stock parts in stock, the overflowing special order bin. Well, if I have a criteria here that anything that's been special ordered and sits on the special order bin, if it hasn't been used for 2 months, I would put 2 months in here, and it gets taken out of inventory. It gets phased out of inventory at that point. And particularly if these usually are service department special orders, I may want to have a quick discussion with the service manager saying, look, these are slated for return. Do you want to take them out of inventory? Normal stock parts with a model range of let's say 2014 to 2016 model years will not be phased out, and they may be the initial parts order shipped by the manufacturer that well, they haven't had demand because there's mostly maintenance work right now, but let's still keep them there unless the manufacturer, and that's fairly common, the manufacturer allows you to return some of these initial parts shipments after a period of time if there hasn't been demand. So as discussed, rigid qualifying criteria need to be established and then stick to them for the phase-in and phased-out parameters, and the economic ordering quantities and price breaks, the benefit of these system refinements, if properly evaluated and implemented, will really fine-tune inventory management. Now, you should be in a position after this discussion to do an initial assessment of the posted Central Park Auto Sales case study that you are asked to submit your initial evaluation on that during the 3-day in-class session, on day 1 of the 3-day in-class session. For further information on DMS data, if you're not clear about where exactly do these numbers come from, and data that feeds into these core KPIs and the related performance monitoring checklist, you may want to refer to chapter 5 and 6 and have a look at that before you do the Central Park Auto Sales case study. So this then concludes the review of advanced inventory management concepts and measures. And the next 2 chapters will get into typical systems reports and performance monitoring. Those are chapters 5 and 6 that I just mentioned. Thank you.